gold will be just fine, and gold will probably get to 2,400 this year, in my opinion. I think silver will get into the 30s this year. A short squeeze, and it'll take some real buyers to step in and force the shorts to cover. But I think long term, I think silver is a heck of an investment here, and certainly, again, it's an investment in physical. I don't want to be a buyer of paper. I don't think there's enough paper, silver or gold, to cover the amount. I don't think there's enough physical to cover the amount of paper that's been written for gold and silver. And I think you better be very careful to what you're buying. And I think that physical is the way to buy if you're going to buy the precious metals, because, again, I don't believe there's enough metals in the world to cover the paper that's out there on it.
Gold rallied to $2,031 but encountered resistance at this key technical level and recent high, suggesting a potential pullback. This price point was previously identified as a target zone, highlighting its significance in the current market environment. Todd Bubba Horwitz, founder of BubbaTrading.com, shared insights into gold's trajectory in 2024 and the strength of the US dollar. Despite recognizing short-term fluctuations, Horwitz expressed confidence in gold's ability to hit all-time highs in the coming year. He speculated that gold could reach as high as $2,400 per ounce. As the gold price holds onto its gains, investors are awaiting the release of the FOMC minutes from the first monetary policy meeting of 2024. This will provide further insights into the timing of potential rate cuts. The near-term outlook for gold remains bullish, particularly amidst deepening tensions in the Middle East. Horwitz emphasized the importance of physical metals over paper investments, highlighting the tangible nature of gold and silver as effective hedges against currency devaluation. He advocated for a return to a system where the dollar is backed by a tangible asset like gold, suggesting that this would provide a more accurate measure of its value. The United States moved away from the gold standard in 1971 under President Nixon, decoupling the dollar's value from gold. The announcement by Zimbabwe to introduce a gold-backed currency as a replacement for its almost worthless dollar further fueled the discussion on the role of tangible assets in currency valuation. Join us as we explore the insights shared by Todd Bubba Horwitz. Stay updated by subscribing to our channel and activating notifications. Thank you.
Really, gold stuck between 2,000 and 2,100. I mean, you had dip below for a minute, but it's really just in consolidation, and it looks like it wants to go higher. I think gold will make a new high this year. I think that you're seeing also a little bit of competition from crypto as well, from Bitcoin. Bitcoin's had quite a move right now, and a lot of investors are using that as some stored asset value as well. But I think that gold will be just fine, and gold will probably get to 2,400 this year, in my opinion. I think silver will get into the 30s this year. Again, my biggest concern is platinum, because I think platinum is a heck of a value down here, but it just doesn't seem to move. And, at one time, platinum was over the price of gold. Now it's under. And I think the big thing we also have to look at is the gold-silver ratio, which I don't know has ever been this high before.
Let's talk silver. Let's talk about gold's little brother here for a second. Why is it lagging gold so much?
There's just a lot of sellers out there, and there's a lot of pressure on it, as it always is. And it'll take a big short squeeze, as we saw when it went to 50, if you remember back in the day. It'll take a short squeeze, and it'll take some real buyers to step in and force the shorts to cover. But I think long term, I think silver is a heck of an investment here, and certainly, again, it's an investment in physical. I don't want to be a buyer of paper. I don't think there's enough paper, silver or gold, to cover the amount. I don't think there's enough physical to cover the amount of paper that's been written for gold and silver. And I think you better be very careful to what you're buying. And I think that physical is the way to buy if you're going to buy the precious metals, because, again, I don't believe there's enough metals in the world to cover the paper that's out there on it. It's not a surprise. This has been coming for years. Ever since COVID, we know that there's no longer big cities that people have to go into an office anymore. So the market, the commercial real estate market, is shrinking. I don't think it's a big surprise. I think the straw that breaks the camel's back is going to be banks are going to start to fail again, as they did in 2008. I think we see this big picture and we forget about the little picture inside, and suddenly you start seeing some trouble. Right now, everything is fine and everybody's happy and they think that everything's in good shape, but it really isn't. And you're seeing a lot of concerns. And I think you start to get reassurances from different organizations, which is the same as when they tell a coach, hey, your job is safe, and then they fire him the next day. When you start getting reassurances, and I go back to 2008 in September when Paulson came out that the banks were great, well, guess what? They weren't. And I don't think they're great now. I think that the banks are in a lot of trouble. And unfortunately, the taxpayer gets to bail out the banks because the Fed will do the same thing they did in '08. Well, I think the bond market is going a lot lower, which again would push interest rates a lot higher. And that's my opinion. I may be wrong, but I don't see how there's any chance that we're going to go lower. I mean, there's not enough real demand for bonds to push prices higher, and I think interest rates are mispriced here. Even what Powell is saying, and it was interesting. He was on 60 Minutes, and they asked him about the 2% target for inflation. He goes, "I don't know why we use a 2% target," basically. And at the end of the day, they've made a mess of the economy. They've made a mess of the amount of debt that we're carrying. They've made a mess with the jobs because in 2023, 63% of the jobs were either government or special interest jobs. So we've created a real mess, and now we're getting massive amounts of layoffs. So I think that interest rates are going to go higher because they put themselves into a spot that they can only go higher from here.
NVIDIA is set to announce fourth quarter earnings after the bell in a report highly anticipated by Wall Street, which will provide insights into the sustainability of the ongoing AI boom. Analysts predict that NVIDIA will report a remarkable 240% increase in revenue from the same period last year, totaling $20.6 billion, with $17.06 billion attributed to data center revenue. However, Todd "Bubba" Horwitz is cautious about the current market, suggesting it might be overheated. He warns that if demand weakens, there could be significant price drops. This sentiment is echoed by the shifting expectations of Fed rate cuts. While bets on lower rates were strong a few weeks ago, they have since diminished, and the likelihood of a rate cut by June is now wavering. Looking at the bond market, which typically has an inverse relationship with interest rates, the speaker believes that interest rates will continue to rise. The 10-year, for example, has increased from below 4% to 4.3% and 4.4%. Indicating a growing expectation of higher interest rates in the future. Let's get back to the interview.
But NVIDIA's had a heck of a run. I mean, I don't know how much higher it can go, but you look at SMCI, it went up 200% in 3 weeks. So, right now we're in that 90s internet bubble type of situation where stocks just go to Pluto out of nowhere. And of course, they're very thin. And what people have to remember is that on the other side of every trade is always a go-between or a market maker, and they're not going to give it away. So if the demand starts to pick up, they're going to widen the bid-offer spreads, and it means that the jumps are going to be bigger as they go up. And I think that this is NVIDIA trading at 800 or so. I mean, it could go much higher. It could crack after the earnings. I have really no clue where it's going to go. My assumption would be it would go lower because they have to have priced in pretty good earnings already. The big high tech, which has exploded higher. And, listen, it is what it is, and you can't fight it. I mean, we've been long throughout most of this rally. Not that I want to be, but of course, remember, you can't fight what the markets are doing. And that's one of the big things everybody has to remember is no matter what you think, no matter what the news says, the tape is the all-out story. And the close of the market is where it's at. And if you're against it, you're losing money. And I think that the bond markets tell you that they're going higher. And I never believed that they were going to be able to cut rates. But again, that was the story. But if you look at the bond markets, the bond market futures are inverse to interest rates. So if bond market futures are going down, that means interest rates are going higher. The 10-year has hit like 4.3 for the first time in quite a while. After hitting 5% last year, broke all the way down under 4. Now it's back to 4.3, 4.4. And again, to me, that's the biggest benchmark that replaced LIBOR for mortgage markets. And to me, it's going higher. Look at the rates of mortgages. I mean, you got 7% mortgages now. And that's still relatively cheap if you're an old guy like me, because my first mortgage was 13%. But if you're a new home buyer that bought, in the last 10 years, you were paying, 3-4%. So again, it's all what you're used to. But I think that rates are going higher. And I think that before it's all said and done, that 10 years is going to be about 5 or 6%. Money is too cheap. And that's what's applying and making us in such deep debt is because money is too cheap. But no, what people don't remember or realize is that not everybody has the luxury of the benefit of getting that cheap money. I mean, you have in this country the highest amount of credit card debt. And I'm not talking about dollars because dollars are, when I started trading, the Dow was 800. So now it's 40,000. But we have the highest number of people at limit on at least one credit card paying the minimum payment. Now, how long it takes to pay a credit card back. It's longer than a mortgage if you're paying the minimum payment every month. And I think that the consumer is way too stressed out. And I believe that if you did a real honest to goodness stress test on the banks, you'd find out that the banks were way over leveraged as well. And I think that's a problem that nobody's talking about either.
Do you agree with his assertion that physical metals like gold and silver are more reliable hedges against currency devaluation than paper investments? How do you perceive the shifting expectations of Fed rate cuts and the implications for the bond market, as discussed in the video? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.